Hey traders, this is Blake Morrow with Trader Summit. With me, I have Michael Brown, Mr. Michael Brown. He is from Caxton, head of market intelligence over there. How are you, Michael? Good to see you again.
Great to see you, Blake. I'm very well. How are you doing?
I'm doing great. I always really enjoy our conversations because your depth of knowledge about central banks and expectations is just, I like to say it's second to none. I love your opinions. I
That's
love
very kind of you.
yeah, I love your thought process. And right now is so important to the market as everybody's talking about inflation. And with these inflationary pressures, I ask myself, and I'm sure you asked this and everybody else is asking this as well. What are central banks going to do? I mean, when you're talking about the ECB, the Bank of England, the Fed, are banks going to live up to these hawkish expectations because of inflationary pressures? But is it going to weigh on growth, or do they have to not be so aggressive to make sure growth doesn't collapse? What are your thoughts here? I know it's a loaded question, but how do you feel? How do you feel about this
well,
whole quagmire we're in?
well, I think that's a great word for it. I mean, central banks are certainly having to walk a very, very delicate tightrope at the moment. Now, we shouldn't feel too sorry for central bankers. They're paid perfectly well to deal with this sort of situation. But as you say, on the one hand, they've got this real issue with inflation. Price pressures are much more intense and much more longer lasting than we'd previously expected. And now we've got the war in Ukraine, of course, adding additional upward pressure on inflation as well.
Right.
And then on the flip side of that, you've got growth, which is slowing anyway, because this kind of post COVID sugar rush is starting to fade. And then the geopolitical developments as well are also posing stiff growth headwinds. So, yeah, very delicate balancing act for central banks to walk. And I think we're seeing quite an interesting transatlantic divide in a way, because yes, market expectations for policy are very, very hawkish at the moment. I'm just looking in front of me. The market's got 8.5 further Fed hikes priced this year. The market is expecting the BOE bank rate to get to 2% by December, and for the ECB to end their negative rate policy by the end of the year. Now, what we've heard from central banks would support that idea. Central banks have been relatively hawkish, but slowly but surely, I think we are starting to see a little bit more of a dovish pivot. Firstly, from the Bank of England. Governor Bailey has spoken a few times in the last couple of weeks and really been flagging the increasing risks to the growth outlook rather than talking about inflation, which is what Chair Powell has been doing, just banging on nonstop about inflation. And I think this leads me to believe that actually, in terms of market pricing, while the market is probably too aggressively priced across the board, there's a much greater chance that central banks the Fed deliver what the market has priced in than there is the European Central Bank or the Bank of England, who I think will probably back away from their hawkish bent relatively rapidly as Q2 progresses and as growth momentum wanes.
So you still believe that the Fed is more capable of living up to their hawkish rhetoric at this point in time?
I do. I mean, I still think the market is overdone. I still think that a 3% Fed funds rate in the middle of 2023 is way more aggressive than is likely to happen. If you think about the last economic cycle, we got to 2.5% and had to stop because things were on the verge of breaking.
Yeah.
Those kind of structural factors have only got worse since that last economic cycle. So I think rates may even peak at a lower level than we saw in the previous cycle. But I do think the Fed are probably more capable of living up to their rhetoric and living up to market pricing than central banks in Europe, particularly given that we're already seeing how exposed the Eurozone economy is to the war in Ukraine. And that is only going to get worse as time progresses.
I was going to ask you, Michael, when you're looking at the euro, and the euro right at the time of us, filming, it's trading below 110. But I mean, would you say it's actually holding up relatively well based
It is.
on what's happening? Right. I was going to say based on what's
Yeah.
happening, and then expectations so lofty for the Fed, and maybe the idea that the ECB is not going to be able to live up to their rhetoric and the Fed will is what's keeping it capped. But at the same time, I'm like, why isn't the euro near parity? Do you have those same questions?
Yeah, definitely. I mean, those of you who've sort of followed my analysis for a while will know I've never entirely been the biggest fan of the euro, so it always somewhat surprises me how resilient the currency is. But yeah, I think euro dollar at 110 is incredibly surprising. I think one thing you've got to bear in mind is that the FX market as a whole has settled into a little bit of a range over the last sort of 2 or 3 weeks, besides the yen, of course, but we all know what happened there. But I do think it is very surprising. And I think perhaps this is a sign of the market saying, we've got to a point where we've priced in as much tightening and as many rate hikes as we're going to. We're now going to sit back and wait and see what central banks actually do. Do we get 50 basis points from the Fed in May? Do we get the ECB bringing QE to an end in Q3? And I think we might just be in a little bit of wait and see mode, probably perhaps even for the next kind of month or so until that next Fed meeting, when we get a bit more clarity in terms of the outlook. I think the resilience in the euro is certainly not due to any euro specific factors. The currency still doesn't have particularly much going for it, being in a low growth, high inflation, low yield spot in terms of the G10 market. I think it's more the fact that everyone's kind of hit the pause button and gone, we've taken this pricing as far as we're going to take it in terms of the Fed. Let's now see what they deliver before either driving the dollar higher. And I think the bar for further dollar gains is pretty high, given how aggressive pricing is, or before we reverse course a little bit. And I think patience is probably the name of the game at the moment.
Well, you brought up a topic I didn't expect to really have this discussion with you, but knowing what Caxton does as far as working with companies globally and dealing with probably currency hedging and everything else, how have you viewed this move in the yen? I'm throwing this kind of out at you, but the yen obviously is so weak going into fiscal year end in Japan. Do you read too far into that, or do you think the dollar yen can really extend above 125 and we could see continued yen weakness moving forward? Because I personally, I try to ask myself, do I have any good reasons really to be long yen? And I can't really come up with them in my own mind. So what are your thoughts with the yen and its recent move?
Yeah, I mean, I would struggle to come up with them as well. I think it was an obvious example of a move that went too far too fast. I mean, I remember saying at the time that, I think when we went through 122, I was saying this has gone too far too fast. I certainly didn't expect it to go another 3 big figures in the next sort of day and a half.
Right.
I'm glad you mentioned fiscal year end, because I do think that skewed things somewhat and did accelerate that move higher. But when you look at what's going on, you've got 9 out of the 10 G10 central banks raising rates, slowing or ending asset purchases or running down the size of their balance sheet. And then you've got the BOJ out there on their own saying, we're going to keep 10-year yields capped at 0.25%, actually accelerating their bond buying to do that. It is pretty much the perfect ingredients for a weaker currency and a weaker yen. So I agree with you. I don't think there's any convincing reason to be long yen at the moment. What I would say is if we see the move go as quickly as it did previously, that's likely to raise some alarm with the Japanese fiscal authorities. We'll probably get a bit more verbal jawboning. But if we see a bit more of a slow and steady move, then I think we could easily break 125. And I think it's probably not until 130 on dollar yen where the BOJ and the Ministry of Finance would get a little bit more interested. But certainly I don't see any convincing reason to be buying the yen at these levels.
It's for those of us that have been in the markets for 20 some odd years, we remember the good old days of the yen carry trade. And this is really fostering that type of that environment again, when you have other central banks that are going to be raising rates and the Bank of Japan is not. So I can see all these yen pairs continuing to rally as long as risk doesn't collapse, I guess, right?
Yeah, I think that's the big thing, isn't it? If risk appetite does collapse, then obviously the yen and we can throw the Swissy in as well are going to find a pretty chunky amount of demand. But at the moment, if you look at where risk assets are trading, the S&P has pretty much erased all of the losses associated with when Russia started to invade Ukraine. That seems to have, although obviously the situation on the ground is continuing and is still pretty harrowing, it seems to have sort of faded to the back of the market's mind at least. So I think risk assets should remain relatively firm. And unless, as you say, we do see some sort of collapse in risk appetite, there's no reason why the yen should rally from here.
Michael, I don't expect you to be some Russian expert, but in your opinion, do you think this is going to be ongoing? Are we getting closer to the beginning of the end, or are we still far off, based on your opinion? What would you think?
Yeah, I mean, as you say, I'm certainly no expert on this kind of thing. I think this is going to be quite a drawn out process. I certainly don't think it's going to be over next week. I'd love to be proved wrong on that, but
Yeah.
sadly, I don't think that's going to be the case. I think it is going to end up being quite a long, drawn out conflict. Maybe even it's going to go on for years. Who knows? But I think what is pretty clear is the initial kind of macroeconomic impact of the conflict is now clear. It's higher inflation, it's slower growth, not only because of what's happened, but also the sanctions. And that has pretty much been discounted by the market. So, we are going to have to adjust to a world where, Russia is somewhat cut off from the global financial system, and Ukrainian food exports, for instance, are significantly lower than they were before the conflict began. Yeah. But, I think the initial impact of that, at least, has now been fully discounted by the financial markets.
Well, now we got to see what the central bank responses are going to be on your side of the pond, I'm assuming.
Yeah, well, I think going back to, my second or third interview with you, I think we're certainly going to see some pigs flying. The ECB probably will hike rates this year, but just not to the level the market expects. And I reckon the BOE will probably go once more in May before hitting the pause button and waiting to see what happens while the Fed continue to tighten. So perhaps that's going to be a catalyst for more dollar upside. But as I said, I think the market's pretty much fully priced when it comes to US monetary policy. So the bar for further dollar gains is a pretty high one, I think.
Well, Michael, I have to say that the new view that you have from that corner office there and all the windows, you might actually be able to catch a pig flying sometime in the coming months. I'll be on the lookout for them. And I want to say, hey, following you is always fun. I really enjoy our conversations. I think you're one of the really, really shining stars over there, in the UK. I love listening to your analysis. But if I'm just learning about what you do and what Caxton does, can you tell traders how to follow you?
Yeah, of course. So caxtonfx.com, all of my analysis is published on our blog there, and also Mr. M. Brown on Twitter and a whole host of other social media sites if you want to post or catch what I post throughout the day. And thank you very much for hosting me once again.
Hey, thank you for being here. And I can't wait till we get to catch up, hopefully in the next few weeks. And it's always the pigs flying. We're going to be looking. We're going to keep our eyes open.
Definitely. Let's do it again soon. Cheers, Blake.
All right. Talk to you soon. Bye-bye.
Thanks.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.